You're new to real estate investing, but you know that real estate is a place where a lot of people have built enormous wealth. And this is something you want to get into, but you just don't understand how you can actually get started, how you can make it happen. Well, in this video, I'm going to break down the core concepts, everything you must understand before you put a single cent into a real estate deal. So there's going to be three things I'm going to be breaking down for you in this video, but the first one is the business of real estate. Because we have to think of real estate as a business. A lot of people, the biggest mistake they make is they think, oh yeah, well, I'll just acquire this house, or I'll just buy this piece of property, I'll just run it for the next 30 years and it's just going to be a hobby. Wrong way to think about it. You are acquiring a business, and business people have a plan going in. And they also understand, well, what makes a business successful. So with real estate, our product is housing. A lot of businesses, they'll sell shoes, you can sell groceries, you can sell services. Well, the business of real estate, what you're getting into, the business you're starting, is the business of housing. So our product is a roof over somebody's head. So it's housing. Housing is the best product you can ever sell because people can lose their businesses. They can close up shop. We saw this during the lockdowns a number of years ago, but the last thing they will give up is their house. This is why real estate in general is the most stable investment vehicle out there. People always need a place to live. With any business, we have an income stream and we have expenses. So in terms of the revenue, the income side, there's a couple of different ways we can make revenue in real estate. Well, the first and foremost is the rent. This is how much your customer, your tenant, is paying you in exchange for the housing that you are providing, the house, the roof over their head. And they're going to pay you a set amount every single month, generally on a contract. So they'll sign a contract with you, a lease for 1 year, 2 years, sometimes it's short term, 6 months, something like that. But you've signed a contract with them and you said, hey, listen, I'm going to provide you the service, the housing, in exchange for the monthly rent. But there's other ways you make money. You can actually charge for parking depending on the type of property you have. So that's additional revenue. Maybe you have laundry services. Maybe you have coin-operated laundry. Maybe you rent a washing machine and a dryer in the unit for X amount a month. There's so many things that you can do here. Maybe you will have preferred parking at your property. Maybe you have Wi-Fi and you offer that as a service in exchange for a monthly fee. There's so many different streams of revenue because remember, as a business thrives and it grows and it dies based on the money it makes, the revenue it drives. So always remember, when you're investing in real estate, you're starting the business, the product is housing, and you have to focus on how do I drive the revenue. Now on the flip side, every business has expenses, right? There's the cost of doing business, and some of the expenses will be management of the asset, who's looking after the tenant, who's looking after repairs, all that kind of stuff. That falls under management. And then you have renovations that you do, something goes wrong, you have to fix it. That goes into operating expenses. And then you actually have the cost of debt, right? So you may have a mortgage on the property, a line of credit, other type of debt. Well, you have to pay the bank every single month to use their money to acquire the piece of real estate. You have insurance costs, like the list goes on and on. You have utilities, maybe you have to pay for power for the common areas. Maybe you're including the water, depending on how you set things up. So these are all the expenses. But at the end of the day, you have to make sure, just like with any business, your expenses do not exceed your income. Because what happens when we take our income and subtract the expenses, that gives us something called NOI, net operating income. Now, I'm not going to get too in depth with this. If you are interested in exploring more about the NOI, I'll put a link to this video where I break it down more in depth. But for right now, as you just getting started exploring and understanding real estate investing, all you have to think about is, hey, now I have to look at real estate as a business. I'm offering this product. I have income coming in. I have expenses. And to be profitable, I have to make sure that my income exceeds my expenses. Now, I'm going to show you how you can supercharge your returns and make more money. But first, I think it's really important to understand the second thing I want to cover, which is what makes a real estate deal. What pieces do you have to bring to the mix to have a deal happen? Now, the fact is, every real estate deal in history has had these 4 components. And I call this the real estate matrix, because if you're missing one of these, the deal doesn't happen. Now, the first thing we need is the actual deal itself. We need the property. Now, the deal part encompasses a lot of things, right? You have to do research on the market. You have to understand where you're investing. You have to know it's a good place to go. Know what types of properties you're looking for. You have to walk them. You have to put offers, right? You have to get a deal under contract. You have to have a signed agreement saying, hey, I'm going to buy this property for X amount. That's the deal. This is where everything starts. Without the opportunity, the deal doesn't work, right? You're not going to make any money. So you have to have the deal itself. Then we have equity. For how much money do you need to actually get this deal done? If you're going to buy an asset for $1 million, well, if you pay all cash for it, well, you need $1 million to acquire the piece of real estate. If you're going to the bank for a mortgage, maybe for half of it, $500,000, well, you need another $500,000 to make up what the bank's not going to give you. Now, with equity, you can get all the money yourself. So if you have all the money in the bank, well, you can use that, or you can actually raise money from other people and apply it to your deal. The third piece of the real estate matrix is financing. The money that somebody else is willing to lend you, generally a bank, right? Because if we're trying to acquire a piece of real estate, let's say it's $1 million, and you don't have all the $1 million, but it's a good deal, it's going to produce money, well, a bank will loan you and charge you interest on that money to let you use it. So let's say you go to the bank and say, hey, Mr. and Mrs. Banker, I have this piece of real estate. It's worth $1 million right now. I have it under contract. I'm looking for a mortgage. I have maybe $500,000. I have half the money I need. Will you loan and give me the other $500,000 I require to do this deal? And the bank's going to look at the deal and say, oh, well, this makes a lot of sense. Here, I will loan you the money, but I'm going to charge you this amount of interest every single month or every single year in exchange for you using that money. And this is what's called leverage. But you need financing in a deal because generally speaking, most of the time, you're not going to put all of your money in a deal. And last but not least, the final piece of the real estate matrix that you need to make a deal happen is management. Now, a lot of times when people say management of a real estate deal, they think property management, which is where, somebody goes to collect the rents, they make sure the tenant's okay, they're dealing with any issues, that kind of stuff. When I say management of a deal, I mean, yes, that type of management, but also who's making the key decisions? What type of debt to use? Do we need more debt? Can we pay off the debt? How do I raise rents? When do I raise rents? What renovations am I doing? When is a good time to sell? These are the management decisions that make you or lose you money. When you have all 4 of these things in one deal, that's when the deal can happen. If you have the equity, if you have the deal, and you have the financing, but you don't have management, the deal can't work. These 4 keys right here make up the real estate matrix, and you must have every single one of these to have a deal work. Now you know the 4 components that you need to make a deal work, but how do you make more money in a deal? Because at the end of the day, like I said, we're running a business, which is in the business of providing housing, and the whole goal of a business is to make money. So how do we supercharge our returns? Well, it all comes down to leverage and capital. Let me talk about leverage first. Remember in the real estate matrix how we were talking about financing and how we can go to the bank to have them loan us money to complete the deal? This is where we supercharge our returns, or at least one portion until we get over to capital. If we're able to wrap up a piece of real estate and tie it up and get ownership of it, but we don't have to put everything in cash, well, our returns when we exit the deal, when we sell, or when we earn money from rents, that's going to increase the returns we're earning on the property. So for instance, if I have to pay all cash for a deal, my returns are going to be what they are, right? Now, if I only have to put half of my cash in the deal, and then I do the other half financing, my returns are going to be even greater. And then let's say I only put 25% of my cash in the deal, and then I have 75% of the bank's money in terms of debt, my returns will increase even more because I'm controlling the same value of the asset. The asset's producing the same amount of income, but I have less of my capital invested in the deal. So my money is being more efficient and it's earning more for each dollar I have invested. Now, on the flip side, we don't want to over leverage. And this is where a lot of beginners get into a lot of trouble. You may think, oh, okay, well, if I put only 5% of my money in and I go to the bank for 95%, well, that's even better. Well, it's not, because you need to have equity in the deal. You have to have your money in the deal, because number one, when you get money from the bank, it's going to cost you. Like, you have to pay interest. Number two, if something goes wrong and now the value of the asset drops, well, the bank's going to come knocking, because now you owe the bank more money than the asset's worth. So you have to use leverage very, very carefully, but leverage is where you supercharge your returns. So you want to stay, generally speaking, in that 40% leverage all the way up to 70% leverage, depending on the type of deal you're running. Now, the second piece of supercharging your returns is capital. And like we found in the real estate matrix, it's also called equity. Now, the thing that I learned as I got more and more into real estate is you don't have to save and use your own money to get a deal done. You can actually approach other individuals who have the money and use their money in your deal. So going back to the real estate matrix, so let's say myself, I have the deal. Maybe I have the financing, but I don't have the equity and I don't have the management experience. Well, what I can do in that case is now I can approach another investor who has the money and say, Mr. and Mrs. Investor, I need $500,000 to do this deal. I have the deal. It's going to make money. I have the financing. The bank's going to give me the loan, but I just don't have the down payment. I don't have the equity I require. Do you want to come into this deal? Then I go over to another person who has the management experience, who can make those decisions, make sure the deal makes money. And I go to them, hey, Mr. and Mrs. Deal Manager, I have the deal here. It's going to make money. I have the financing. I have an investor who's willing to invest their money. Now I'm looking for somebody to come in and run the deal for me. This is how we supercharge your returns, because you don't have to do everything yourself. When I first started, I thought do everything on my own, and that kept me playing small. The sooner you figure out that you can leverage other people, you can bring other people into your deal, the more successful you will be. To supercharge your returns, you have to leverage the bank's money because they're willing to give that to you if the deal's good, but you also have to be able to bring other people's money into the deal, their capital, their equity, and partner with other individuals to make sure all four of those components of the real estate matrix are met. So speaking of partnerships and partnering with other people, I've done a video breaking down how to actually set up and structure a real estate partnership. And I even share some stories from myself and all the mistakes I've made setting those things up. So click right here and check out my real estate partnership video.